What's going on, everyone? Today we're going to be talking about other stock market terminology. This will be the last section for stocks. These are just other terms I think you should be familiar with, so let's dive in. Any stock that is on the market today usually has come to the stock market through something called an IPO, and all an IPO is basically taking a company that was once private and putting it on a stock exchange for public investors to invest in. For example, Apple was a private company at one point. Then to raise cash, they did an IPO on the exchange, and that allowed other people in a more public setting to invest instead of just a VC or their own money from their parents or friends. And it's kind of a cash grab in some ways, because there are IPOs that are absolute trash that fail, and they raise a bunch of money but they never deliver on their promises. But IPOs in general are good for the market, good for investors. Another thing you need to be familiar with that are in stocks are things such as warrants, and warrants are a derivative. All a derivative means is it tracks the underlying, it's not the actual thing. So warrants are a derivative that give the right but not the obligation to buy or sell a security, most commonly in equity, at a certain price before expiration. The price at which the underlying security can be bought or sold is referred to as the exercise price or the strike price. And warrants on companies are something you really have to think about when you're buying and selling a stock or you're holding a stock. And some strategies are around buying a stock and selling the warrants, or selling the stock and buying the warrants. Another terminology you need to understand is reverse stock splits. Essentially, a reverse stock split consolidates the number of existing shares of a stock held by shareholders into fewer, proportionally more valuable shares. A reverse stock split does not directly impact a company's value. It does, however, signal a company in distress, since it raises the value of otherwise low-priced shares. Remaining relevant and avoiding being delisted are the most common reasons for corporations to pursue the strategy. Remember, in a couple of videos ago, we talked about the requirements to be on a prestigious exchange like the New York Stock Exchange. For its stock split, this is a good sign. Oftentimes, you may hear this as just a stock split. Sometimes someone may say to you, oh, they did a stock split. And you may think to yourself, well, is it a forward or a reverse? And a lot of times people won't make the distinction. They'll just say a stock split, and they usually mean a forward split. Usually people will just say reverse split right off the bat, but it can be confusing in a conversation. You have to just kind of listen to context. So a stock split is when a company divides the existing shares of its stock into multiple new shares to boost the stock's liquidity. This happened a couple of years ago with Apple. Apple was getting very expensive, and to allow people to invest at a, $90 to $100 price point, they did a forward split, which added more shares, and that's a healthy sign of a company. They're doing so well, their share price is so highly valued, and they want more people to invest. They'll do a forward split. Okay, and the most common ones, like I said, are two for one or 3 for 1. And what's going on, everyone? Thank you for watching this video. If you like this video, please click subscribe and hit the bell notification. Remember, it's not enough just to subscribe anymore. For some fangled reason, YouTube makes you click 2 buttons. That's not my fault, okay? So you have to click subscribe, and then if you want to get notified on new videos, you have to turn on the bell notification.